In the study of thermodynamics, a system that consumes energy faster than it acquires it will eventually reach a state of maximum entropy, total disorder. In economics, this is known as insolvency. There is a pervasive cognitive distortion in modern culture that equates high income with wealth. The assumption is linear. We assume that if one inputs massive amounts of capital into a personal ecosystem, the result is financial security. The data, however, suggests that this correlation is weak and, in many cases, inverse. Consider the National Endowment for Financial Education's analysis regarding lottery winners. Estimates suggest that nearly 70% of people who suddenly receive a massive influx of cash are bankrupt within a few years. This phenomenon is not a result of bad luck. It is a mathematical inevitability governed by a specific financial principle, the burn rate latency. Wealth is not a function of how much money enters a bank account. It is a function of the gap between income and expenditure. When the burn rate, the speed at which capital is depleted, exceeds the intake velocity, the absolute value of the income becomes irrelevant. You can earn $1 million an hour, but if you spend $1,000,001, you are technically impoverished. To demonstrate this mechanical failure of capital preservation, we must examine one of the most extreme financial anomalies of the 20th century. A case study involving a subject that generated over $400 million in gross earnings, an amount exceeding the GDP of some small nations. And yet, in 2003, stood before a federal court, legally destitute. This is not a biography of a boxer. This is a forensic accounting of a collapse. To understand the magnitude of the collapse, we must first quantify the peak. The subject is Michael Gerard Tyson. In 1986, at the age of 20, he became the youngest heavyweight champion in history. From a sociological perspective, Tyson's financial trajectory was unprecedented. He emerged from Brownsville, Brooklyn, an environment characterized by extreme resource scarcity, and was thrust into an economic bracket reserved for Fortune 500 CEOs. By 1988, for his fight against Michael Spinks, Tyson earned a reported $22 million. The fight lasted 91 seconds. This translates to an earning rate of roughly $241,000 per second. At this juncture, the income variable of the equation was solved. In the late 1980s and throughout the 1990s, Tyson was the highest-paid athlete on the planet. According to estimates by Forbes and financial analysts of the era, his career earnings throughout the 90s and early 2000s totaled between $300 million and $400 million. Adjusted for inflation to 2024 dollars, this figure approaches $750 million. For context, the average American with a bachelor's degree will earn approximately $2.3 million over a 40-year career. Tyson generated nearly 200 times that amount in less than 2 decades. However, verified reports from the New York Times in the late 90s indicated early tremors in the infrastructure. In 1997, despite record-breaking purses, Tyson was forced to borrow money from his promoter just to pay income taxes. This highlights a critical breakdown in what behavioral economists call mental accounting. Tyson did not view money as a finite resource to be allocated, but as an infinite flow to be consumed. There was no distinction between gross revenue and net profit. In a business context, a company that spends 100% of its revenue on operations has a profit margin of 0. Tyson was running a conglomerate with a 0% profit margin. The stage was set for a correction. The collapse became official on August 1, 2003. Mike Tyson filed for Chapter 11 bankruptcy protection in the U.S. Bankruptcy Court of the Southern District of New York. The filing documents serve as a forensic ledger of the subject's burn rate. They reveal a disparity between income and lifestyle that defies standard arithmetic.
At the time of filing, Tyson reported debts totaling approximately $23 million. Let us dissect the line items of this insolvency. M1, the tax burden. Tyson owed $13.4 million to the IRS and another $4 million to British tax authorities. This indicates a fundamental failure to account for the gross versus net reality. In the United States, high-income earners are subject to taxes that can exceed 40 to 50%. Spending gross income ensures tax delinquency. Item 2. Asset liabilities. Tyson's acquisition of exotic animals is well documented, but the maintenance costs were the true hemorrhaging point. The bankruptcy filing listed thousands of dollars a month for the care of his Bengal tigers. The initial purchase price, reportedly $70,000 per tiger, was negligible compared to the recurring liability of food, trainers, and insurance. Furthermore, his real estate portfolio included a 50,000 square foot mansion in Farmington, Connecticut. He purchased it for roughly $4.5 million, but later sold it to the rapper 50 Cent for roughly the same price. The loss was not in the sale price, it was in the carry costs. Property taxes, heating, landscaping, and a staff of gardeners and maids costing tens of thousands monthly for a property he rarely occupied. Item 3. The predatory ecosystem. Financial documents from lawsuit filings against promoter Don King revealed that King's contract took 30% of Tyson's earnings off the top. However, forensic auditors later suggested the real number was much higher due to bill padding and miscellaneous fees. Between 1995 and 1997 alone, Tyson generated $114 million in fight purses. Yet, according to a report by the New York Times, he ended 1997 with a cash shortage. Item 4. Consumer goods. The filing detailed debts to jewelers and car dealerships. He owed $173,000 to a jeweler for a diamond-encrusted gold chain. He owed nearly $600,000 to a limousine company. In one documented instance, confirmed by his former accountant, Tyson walked into a Las Vegas car dealership and purchased 5 Bentleys in the single afternoon, 1 for himself and 4 for his entourage. The cost was roughly $1.5 million. This transaction took minutes. The labor required to earn that post-tax $1.5 million, even for Tyson, involved months of training and physical trauma. By August 2003, the mathematics had resolved. The inflow of capital had slowed due to declining fight performance, but the outflow, the fixed costs of the mansion, the staff, the tigers, the debt service, had remained static. When the variable income dropped, the constant expense crushed the system.
The collapse of Mike Tyson is often dismissed as a result of stupidity or excess. This is a reductionist view. From a behavioral economics standpoint, Tyson was a victim of Parkinson's law. Cyril Northcote originally posited that work expands to fill the time available for its completion. In finance, the corollary is expenditure rises to meet income. When income increases, the human psychological baseline for necessity resets. This is known as the hedonic treadmill. Hedonic treadmill. A concept introduced by Brickman and Campbell in 1971. The theory states that humans rapidly return to a relatively stable level of happiness despite major positive or negative life changes. For Tyson, a $300,000 car became the new baseline. To feel the dopamine hit of a purchase, the next expenditure had to be larger. This creates a linear or often exponential relationship between earning and burning. The critical error in Tyson's financial architecture was the lack of capital retention. Wealth is defined by a simple equation. Wealth equals income minus expense multiplied by time and rate of return. Tyson focused entirely on the first variable,
income. He ignored the subtraction of expense. Therefore, his equation was effectively 400 million minus 423 million multiplied by time. The result is negative. This pattern is not unique to boxing. A 2009 Sports Illustrated study estimated that 78% of NFL players are either bankrupt or under financial stress within 2 years of retirement, and 60% of NBA players are broke within 5 years of leaving the league. The data suggests a structural inability to transition from high cash flow, which is a river, to high net worth, which is a reservoir. High cash flow masks underlying insolvency. As long as the river is flowing, you don't notice the reservoir is empty. When the river stops, as it does for all athletes, the drought is immediate. Furthermore, Tyson's capital was not working, it was consumed. Had he invested just 50% of his post-tax earnings, roughly $100 million, into a standard S&P 500 index fund, yielding a historical average of 7 to 10%, even without ever working again, the annual passive generation would have been $7 to $10 million. He traded an infinite passive income stream for finite material depreciation. To verify this principle, we must look for a control group, a subject in the same industry, same era, with similar earning potential, but a different variable regarding expense and investment. Enter George Foreman. Like Tyson, Foreman was a heavyweight champion. Like Tyson, he had a lucrative career. However, Foreman's approach to the burn rate was fundamentally different. In the 1990s, while Tyson was purchasing tigers, Foreman was structuring equity deals. When Salton Inc. approached Foreman to endorse a fat-reducing grill, Foreman did not settle for a flat endorsement fee, which is cash flow. He negotiated for a percentage of the revenue, equity. In 1999, Salton bought out Foreman's rights to the grill. The payout was approximately $137.5 million in cash and stock. The contrast in 2003 is stark. Mike Tyson filed for Chapter 11, net worth negative $23 million. George Foreman, net worth estimated in the hundreds of millions. Foreman understood that income is temporary, but equity is perpetual. He decoupled his wealth from his physical ability to take a punch. Tyson's wealth was entirely dependent on his active labor. When the labor became erratic, the wealth evaporated. Foreman's wealth was dependent on a product that sold while he slept. The Foreman example proves that the volume of income is secondary to the management of that income. Foreman earned less in the ring than Tyson, yet retained significantly more. The variable that determines wealth is not income, it is retention.
What are the logical implications of the Tyson case study for the average economic participant? The data suggests that lifestyle inflation is the primary adversary of wealth accumulation. The danger is not low income. The danger is uncoupled spending. Most individuals operate under the assumption that if I earned more, I would be rich. The Tyson evidence refutes this. If a person cannot manage $50,000 a year without debt, they will likely not manage $50 million without debt. The habits scale. The discipline does not automatically appear with the zeros. The framework for financial solvency therefore requires a strategic decoupling of income and expense. First, the cap. Successful wealth accumulation requires an artificial cap on lifestyle. Even as income rises, expenses must remain fixed or grow at a significantly slower rate. Logarithmic growth versus exponential growth. Second, the gap. The difference between income and expense must be converted immediately into assets that generate their own cash flow.
Third, the defense. You are not paid what you earn. You are paid what you keep after taxes, inflation, and stupidity. Consider the mathematics of the gap. If an individual earns $100,000 and spends $100,000, they are financially identical to a person who earns zero and spends zero. They have 0 degrees of freedom. If an individual earns $50,000 and spends $40,000, they have a $10,000 surplus. This surplus, applied to the compounding formula, is the seed of sovereignty. Tyson had a surplus of 0. The lesson is forensic. High consumption is often mistaken for high wealth. In reality, high consumption is the destruction of wealth. Every dollar spent on a liability, a car, a tiger, a party, is a soldier removed from your army. Tyson annihilated his own army. Looking at these events, one can observe patterns that appear across industries and decades. The scale changes, millions for Tyson, thousands for the average worker, but the mechanics remain identical. When you receive an unexpected bonus, a tax refund, or a raise, what is the immediate psychological response? Does the mind drift toward upgrade, a better car, a larger apartment, a new phone, or does it drift toward acquisition of equity? The Tyson case forces a confrontation with the concept of enough. If $400 million was not enough to secure a future, then no amount is enough without a governing structure. Where in your own financial architecture does the burn rate match the income? That is the leak. That is where the entropy begins. It is worth noting that Tyson eventually recovered. Through reinventing his brand, acting, and business ventures in the cannabis industry, he has rebuilt a semblance of stability. But the lost decades and the lost hundreds of millions are gone forever. The forensic conclusion is clear. Solvency is not a result of how hard you hit. It is a result of how much you hold. You do not build wealth by earning. You build wealth by not spending.